All right, welcome back to the Daily Mastermind. My name is George Wright III with your daily dose of inspiration, motivation, and education. And I am super pumped to give you access to some information today. Listen, I know everyone is pretty anxious and some people even stressed about the outcome of the upcoming presidential elections in the U.S., but I'm not going to get into politics. I just want to say this. Sometimes the best offense is a great defense when it comes to your financial planning, your taxes, your business, and your growing your wealth. So I'm really happy today to bring you an amazing discussion. It was a private exclusive event that we did with Scott Estel, who I've had on our podcast in the past. Scott's going to break down the ins and outs of the Trump and the Biden tax proposals. I want you to have a really good understanding of what the differences are in these proposals, a completely neutral understanding. Now, as a reminder, Scott was a former senior trial attorney for the IRS. He's an amazing expert when it comes to tax strategies for individuals and businesses. He's written numerous books. He's spoken. He usually comes and works with our high net worth clients. But he's also sued the IRS on behalf of his clients thousands of times. So this is a guy that definitely knows what he's talking about when it comes to taxes for entrepreneurs and investors and individuals. And my goal with providing you with this today is really to just give you an objective overview of the details of the proposals from both candidates and what they're offering so that you can, number one, be informed, and number two, you can better prepare yourself for your year-end tax planning and tax preparation that's going to be coming up. So here's a couple of notes. Number one, Scott's going to be referring to a PowerPoint that he used in our webinar. So I'm going to give you access to that PowerPoint and the full video presentation of the webinar in the show notes. So once you've listened to the full podcast, just go to the show notes and click on that if you want to go back and have something to refer to. Number two, if you'd like to spend some more time with Scott, I actually have a rare opportunity. We have a live event coming up in November, which generally we do for a small group in Las Vegas, Nevada, but we're going to live stream that 3-day summit. And this is a summit where we bring in the biggest tax experts, legal experts, and wealth experts from around the country, around the world. But typically it's for a high net worth clients, but I'm going to give you access to that, and I'm going to put a link in the show notes as well. So if you want to come to that 3-day summit, that Protect Wealth Summit, then just click on that, and I'll put a link in there that'll allow you to get tickets for free if you're serious. So my goal here is to get you thinking more about saving thousands of dollars in your taxes, both personally and professionally. And with that said, I'm going to go ahead and turn it over to Scott. I hope you enjoy, take some great notes, and I will talk to you soon. Have a great day.
And thank you, everybody, for joining me here this evening, and try to keep this as brief as possible as far as what I've been able to ascertain regarding the different tax proposals here for the two major candidates. And, I think when you're starting to look at a lot of this as to, what is it that the Biden campaign and the Trump campaign, what is it that they're proposing? And what I'm trying to do here tonight is to just give you some ideas as to maybe some thoughts or strategies or plans that you may want to enact in the last 6 weeks of the year. And again, that's going to be assuming that we know who wins either the Senate or the presidency sometime before the end of the year. But a lot of this stuff, again, with the taxes and trying to understand this and figure out what these candidates are doing is just like the trying to figure out tax laws in general. Very vague. Very complicated. I could see that certainly a lot of the Biden plans are going to really satisfy a lot of tax attorneys, because there's going to be a huge amount of tax planning that's going to come into play. And I think, what Don was talking about and Kendall at the beginning was that taxes really aren't on the radar screen this year. I've looked at a couple different polls here, this Gallup one. I'll show a couple of other ones up here, but you see taxes being mentioned quite a bit at the bottom here. So healthcare, gun policy, education, security issues depending on if you happen to be a Democrat or a Republican or independent. But you can see the Gallup poll here, taxes number 11. We can get into the Harvard poll, same thing, taxes kind of down at the bottom. And then also the Yale poll as well, where taxes are down at the bottom. And so, again, not really on the radar screen, but there's a lot of differences between the candidates. And while I necessarily wouldn't make my vote contingent upon one or the other's tax policy, I think it certainly would help to know what those policies are, and also that if we get into a situation where we may have to do some end of the year tax planning, at least perhaps tonight, we can set the table for what that planning may look like. So what did I do here to kind of put all this together? Well, it was pretty easy for Biden's campaign. I went to joebiden.com, pretty thorough there, although again, a lot of the proposals not so thorough, but a lot of different documents and PDFs on different proposals, including his tax plan. Given that there wasn't a 2020 Republican platform, there wasn't really any place I could go other than to donaldjtrump.com. And he's got this Fighting for You with 50 different bullet points in there. And there's a couple of them that are related to taxes, but most of them were just more general targets of what he's shooting for in different areas, taxes being just a very small component. So I went to Forbes, I went to Kiplinger, and I went to the Tax Foundation to see, what they're saying, what they do, some comparisons. And the big unknown as well here is who's going to be writing the tax policy next year. And if you look here between the left and the right, you can see the differences between the first 2 years of the Trump administration and then the last 2 years of the administration as well, and how there's a big difference in the House. But really, in order for either one of these candidates to be able to write their own tax policy, they're going to have to be able to control not only the presidency, but both houses here, the House of Representatives and the U.S. Senate. And at this point, it's unsure, certainly, of how that's going to play out. But let's look at what happens if one of the two candidates now becomes president and now has Congress in sort of their control. So if we say that there's a Democratic House and a Republican Senate, I don't think you're going to get a lot of tax policy no matter which one ends up winning the presidency. But assuming we do have some sort of tax changes, let's look at what it is that the candidates are proposing. Today, we have a top federal income tax rate of 37%. And that 37% starts to come into play when a single person earns about $510,000, and it's about another 100 grand more. I think it's like 612 or so on the married filing joint. And what Biden would do here, let me go back here, I'm not sure why it just moved that ahead. But anyways, what Biden would do is that there would be a top tax rate of 39.6 on income over 400,000. And that number, I'm not sure exactly where that 400,000 number came from, but we're going to see that over and over tonight in a lot of the cutoffs between what is quote unquote high income and what is, going to be taxed at a much higher rate. Okay. Trump here wants to make the 37% tax rate permanent after the phase out in 2026, and is also proposing this 10% rate cut for middle income taxpayers. Didn't say who those were and how the rate cut would be thrown in there, but just wanted to put that out that is a possibility as well. From what I can tell, the Biden tax plan here on the individual side would not increase anybody's tax rates as long as you made under 400K a year. And again, I don't know if that's taxable income for singles, for married filing joint, for both. It was a little vague, but you can kind of see where we're going with this, or where Biden would go with this if he has his tax policy come into play. This is a really big one, And this is one that I want to talk about some of the planning that we may need to do. And the slide here titled Long-Term Capital Gains and Qualified Dividends, both of these have a very favorable tax treatment today. Long-term capital gains, meaning you're holding an asset at least a year and a day before you sell it. And qualified dividends, we're dealing with primarily US companies. But instead of having to pay a maximum of 37% today, this is capped at 20%. So roughly half of what it could be if you were taxed fully as just regular ordinary income. And under the Biden plan, this capital gains rate long term here would increase to 39.6% for taxable income over $1 million. Now, that would be a huge, huge tax increase, certainly to anybody that has big capital gains in any given year. And I'll talk about some ways that I would look at thinking about at least planning for some of the changes. And also planning on maybe being able to sell some securities or what have you before the end of the year if we find ourselves in that position. Trump, on the other hand, is floating a couple of new possibilities here. First of all, there wouldn't be any change to the current tax rate. He's talking about a possible, and this is in quotes, capital gains tax holiday, which again, I don't know what that means, but what I gathered from reading Forbes was that he's considering having a brief period of time next year where you could sell any capital assets, perhaps long-term. I don't know what the amount of time it would be, but there would be no tax bill. And then also the second bullet point, which is something that's been talked about quite a bit, and that is to index your basis for inflation. And let's take a look at sort of how would this play out. If I go out and let's say I buy $1,000 worth of IBM stock today, and I sit there and hold it for 10 years, my basis in that stock is going to be that same $1,000 10 years from now. And the Trump proposal here is saying, well, but my $1,000 10 years from now isn't worth the same amount of money. And therefore, let's say we had a 2% inflation rate, that every year we're going to tack on 2% to the basis. Now, in theory and in thought, I think not a bad idea. The problem here, I think, is going to be able to document this and to be able to do the computations if this change is there. But either way, I think you can see that very, very big differences between the two candidates concerning how they would look at taxing capital gains. Obamacare tax here, this 3.8% surcharge when your income goes over this 200,000 amount, 250,000 if you're married filing joint. Again, this is adjusted gross income, not taxable income. Neither candidate wants to eliminate this tax. So interestingly enough, with Biden, he wants to continue the Affordable Care Act. With Trump, obviously, he's fighting for having the Affordable Care Act be eliminated. And in fact, the Supreme Court will hear a case about a week after the election on exactly this issue. But for whatever reason, he's not willing to give up the tax revenue associated with the Obamacare Act. So what do we do? What do we do here? Well, I think we've got a lot of timing issues that we need to look at. First of all, when you look at the Biden plan, and the Biden plan is saying if you have more than $1 million of income, you're going to pay a very high tax rate, 39.6, and that's going to be on whether they're long-term capital asset sales or short-term. Whether they're wages or qualified dividends, it's not going to matter. And my thought there is, well, does that $1 million income limitation include the capital gain? And in an instance where I've seen a lot of planning where taxpayers end up with a very big difference in their tax situation year to year. So for instance, let's say that I'm married and I make a $250,000 a year. But in any given year, maybe I sell a couple of rental properties, or maybe I sell a business, or maybe I liquidate out a lot of stock or bonds or stock options or something that is going to jack my income up. And my question there would be, does this $1 million income include the capital gain? Or is it just for those folks whose income is $1 million, not including that gain? If so, we need to be very cognizant of installment sales. So if we're making $600,000 and we have a $500,000 gain, and that's the $1 million income hit is going to be triggered here. What if we look at doing this sale over 2 years or 5 years or 10, some sort of an owner carry type of business or sale, excuse me. The other thing that I think we need to be looking at is, should we be selling stocks in 2020 and incurring the long-term capital gains in 2020? How would this work? Well, again, an example here, let's just stick with the IBM stock. Let's say that I bought IBM stock for $10,000. It's now worth $30,000 and I'm going to sell it. If I sell that in 2020, I've got a $20,000 capital gain that is going to be taxed at a maximum of 20%, okay, for the long-term capital gains. If I now push that sale back into 2021 and the Biden tax proposal becomes the law, that 20% tax rate could now virtually double to that whatever 39.6 number. And so not understanding the difference in the plans can have a real big impact on capital gains. One of the other things you can do, and there's no tax provision to prevent this, is to sell your stock, in this case, sell your IBM stock, let's say in December of 2020, and the very next day, turn around and buy it back. And so I've taught many webinars, seminars on stock market trading, and wash sale rules come into play. But remember that you can't have basis issue adjustments, and this gets a little bit complicated, but the basis issue adjustments don't come into play when you make money, only when you lose money. And we're talking about long-term capital gains here. And so when you buy your IBM for 10,000, you sell it for 30,000, and then you book the capital gain for 20 grand this year at presumably a lower tax rate. Now your basis when you rebuy it is set to 30,000, so that if you sell it sometime when the rates are higher, you've got now an increase in the basis and have managed to shelter some of that, the capital gains there from taxes. I think harvesting tax losses in gains is going to be real important. So this timing of sales in 2020 or 2021 is going to be real valuable, especially if you expect your income to go up substantially next year. Perhaps you expect to be selling some rental properties, let's say, where you're not going to do a 1031 exchange, or you're not doing them, let's say, in a retirement account or something where you're going to not have an immediate tax event. So we've got to look at the timing issues here, because again, you could end up selling the asset on December 31st or on January 1st, and your capital gains could be the exact same amount, but simply by waiting one day, you could end up with a tax bill that could be double what it ordinarily should have been. So we want to look at adjusting any basis issues, look if we're going to take any income in these non-qualified stock options. It's going to produce ordinary income tax. We're looking at the non-qualified stock options. All we're talking about there, by the way, non-qualified means that they're not qualified for any special tax treatment. So it doesn't produce a long-term capital gain or some other effect. And if we're going to sell these non-qualified options, again, we want to look at possibly doing that in 2020 when the rates are lower. And of course, everybody's different here in the sense that you may expect your income in 2020 to be considerably higher than it will be next year, in which case even sending and deferring the income to 2021 would certainly make sense. So again, it all depends on your personal situation, but you can't make informed choices without knowing kind of what some of the rules are here. All right, other deductions here now on the personal side before we get to the business side. Currently, there's no cap on itemized deductions. And what I mean by that is, other than the state and local income taxes and other taxes, whatever your mortgage interest is, whatever your charitable deductions are, all of those, you just get to take them, whatever they may be. Under the Biden plan, that would be capped at 28%. So those taxpayers that are in the 28% to 39% tax brackets would be paying extra taxes there in the form of having some of their itemized deductions reduced. And I did read this, that interestingly, this one change here is going to account for about $24 billion of extra tax revenue. So it's not like it's a small amount. I did mention the cap here of $10,000 on the itemized tax deductions for state and local taxes. This one I've had to look at a few times because the Trump tax position won't change this cap, but the Biden position appears that he wants to eliminate the cap, which I was still trying to confirm even later today, and I was getting mixed or conflicting results here and trying to figure it out. But what this cap is that for any state and local income taxes and property taxes, no matter what you have as far as deductions go, the most you can deduct is $10,000. So for instance, last year, let's say that I had a $50,000 tax deduction in terms of 50,000 of, let's say, property taxes plus my income taxes to the state of Colorado. I would only be able to deduct 10,000 of those. The Biden plan would eliminate that cap and allow me to deduct all 50,000. And so again, I think that's a big change for those in these high tax states. Your California, Illinois, New York, Massachusetts, some of the real, like I said, heavy tax states. So from a tax tips perspective, then what do we look at? Well, you can use charitable contributions in 2020 to effectively pay $0 in tax. And at the last 3-day event that we did virtually, I went through a lot of these different ways that you could do this to eliminate your tax bill. But I think you also want to be looking at ways that if you don't need the deductions in 2020, that you may want to bunch your charitable donations into 2021. And what I mean again there is that if you're anticipating higher income for you in 2021, plus higher tax brackets in 2021, then your tax deductions become more valuable. With the caveat that if that cap comes into place for the itemized deductions, we may be better off going into 2020. So again, very confusing here as to how to play this game. I would, though, certainly think that if Biden ends up winning and the Democrats control the Senate, if that ends up happening, I would try to defer any tax payments I'm making until 2021. So for instance, if I'm going to make a $10,000 estimated payment to the state of Colorado for my fourth quarter of 2020, I can make that in December or I can make that in January. And in this case, I would wait till January and hope that I can avoid that cap next year. So again, lots of things to think about. Different tax credits here, and this is where you get into sort of a redistribution of wealth, I think that we're seeing. And really any tax law changes that any candidate or any party puts out and actually can put into play to effectuate into law is going to be a redistribution of wealth. And we saw that with the Tax Cuts and Jobs Act, which really was a main beneficiary of corporations, big businesses, small businesses to some extent, but businesses in general received the major benefits of that particular tax law. Here, the Biden tax plan is going to use the earned income credit, and you can see here where it would be expanded, and also other credits as well, the Affordable Care Act tax credit and the child tax credit. All of these credits that are being used by people with adjusted gross incomes in the lower percentages, let's say the lower 20%, are going to be able to take advantage of some of these credits. And for some of them, they didn't even exist before. And as we'll see, you'll see a couple of credits here where they're brand new. But this one, a $2,000 child tax credit, it goes back down to $1,000 in 2026. This would go up under the Biden tax plan. Under the tax plan of Trump here, there would be no change to current law, but he would add an additional requirement that there would be Social Security verification in compliance in order to be eligible for the credit. So he wouldn't change the amount of the credit, but just add another eligibility factor to come into the credit to begin with. Same thing on this one with the SSN required, but this is a huge increase for the Biden tax plan. So you would see a major change here. And again, tax credits are worth so much more than a tax deduction. And so anybody that has an opportunity to gain a tax credit in this situation of up to $8,000 or $16,000 if you have 2 children, this would reduce your tax bill by $16,000 if you qualified for the max. So again, real big differences on the focus of the tax plans of the 2 individual candidates here. All right, student loan debt. This is one that's a real big issue. I've certainly seen it with my daughters and a lot of their friends, and having really the insurmountable amount of student loan debt that a lot of the students have coming out of college. Today, if that student loan debt is forgiven, it's a taxable event, meaning that whoever has the loan forgiven is going to pay tax on it. And the Biden plan would have an exclusion to taxability. And so if a student loan was forgiven, the Biden plan would say you don't have to pay tax on the debt that is forgiven, where the Trump plan would not change this particular law. First-time homebuyers, this is a brand new credit that the Biden proposal would have up to a $15,000 refundable tax credit for first-time homebuyers. Refundable credits are pretty rare in the tax law, because what this means is that if you qualify as a first-time homebuyer, and we've seen this before, the second Bush, George W. Bush, had a first-time homebuyer credits available back about 15 years ago as well. So we've seen this before with other tax plans, but this is new under the current law. But if, let's say that you had a tax bill of $3,000, but you were getting this credit of $15,000, the government would actually refund the $12,000 difference to you. So who qualifies? I guess we'll wait to see on that. But another new credit, this renter's tax credit, it wants to basically try to cap any rent or utility payments to 30% of your income. How this would be computed, where the compliance issues would come in, your guess is as good as mine on this one. But again, it's another new tax credit that would potentially assist people at the lower income ends of the scale. So we've got this renter's credit, we've got a low income housing tax credit as well. This is available today, and Trump would not change what's currently available. The Biden plan was interesting to me because of so many of the different real estate investors, real estate developers, professionals, and everything that I've worked with over the years, and that the Biden plan would actually expand this credit to provide incentives to build affordable housing, whether that was new construction or whether that was rehab. And so if you're in the business of doing housing to begin with, let's say you are building or you're buying and you're doing flips, you're doing condo conversions, whatever it is, we want to be looking at tax credits, because we now have the opportunity to have the government cover a fair amount of our potential expenses here. So watch this one real closely if you're in that particular line of real estate work where you are looking at affordable housing and you are looking at new builds or rehabs. Electric vehicles, currently tax credits are available, but they start getting phased out depending on income and depending on the number of vehicles that are sold. Biden would just eliminate these caps and restore the full tax credit that used to be available. 401k plans, no tax credit for any contributions. Typically today, what happens is that you make your contributions on a pre-tax basis, and then when you pull the money out, you're going to pay tax at whatever your tax rate is. Biden's plan would permit people in the lower tax brackets to receive a tax credit of up to 26% for their contributions. And I read this several times to try to figure out what we were trying or what he was trying to do here. And what it looks like to me is that let's say that I'm making a couple $100,000 a year, I may be able to put $50,000 into my 401k, where somebody who's making half of that can only put half of that amount into their 401k. And so the wealth discrepancy between the two of us is going to change quite a bit because I'm able to contribute a lot more. And I believe that's where the tax credit is coming in. But again, it's something to watch out for. All right, let's look now at some of the employment taxes, because this is a very big change to what we're seeing today. Social Security tax, this is the FICA tax, caps out at a little bit under 140,000. So that 137.7. And once you go over that, you're only going to pay tax on the Medicare portion, the 2.9%. And that goes on forever. Basically, however high the wages are, that's how high the Medicare part goes. The Biden plan would then have this donut hole in here, where if you make between 137.7 and 400,000, there's no change to your employment taxes. But once your wages go over 400,000, now the full amount applies. So that full 12.4% cap no longer applies once you're over 400,000. And again, I mentioned before that 400,000 amount, that's in here again. So all over the place here, but if this is going to be the case, we may want to look at taking some of the wages this year rather than having to pay that higher tax next year if that comes into play. Same thing with the corporate tax rate. Real big difference here. A flat tax for C corporations, 21%. And that used to be a bunch of different brackets that went all the way up to 35%, typically 37%, I think in some instances. But anyways, that flat tax of 21% under the Biden plan would become a flat tax of 28%. Also looking at alternative minimum tax, there is no corporate alternative minimum tax today. Trump would not change that. Biden would have an alternative minimum tax once income reached 100 million. So this isn't something that most small businesses need to be aware of. But again, just one more difference certainly on publicly traded companies where this AMT could very much come into play and affect different publicly traded companies, their stock results, that sort of thing. Corporate tax credits as well. New proposals here. Biden wants to put out tax credits to incentivizing any sort of modern existing or recently closed facilities, meaning that get any sort of manufacturing back into the United States, and there'll be tax credits to get those facilities up and running. The Made in America tax credit, seeing that under both plans is not a typo here. Interestingly, neither one of them really talk about what that is, other than, to me, it just sounds good. So if you make something in America, we're going to give you a tax credit. And what Trump means by that is anybody's guess. And what Biden means by that is anybody's guess here. But I think what both of them are looking at is how can we get jobs back into the United States or create new jobs in the United States. But here's the kicker. Here's the big one. The big change, in my opinion, for the average small business owner in the U.S., certainly the flat 21% corporate rate, but this qualified business income, this QBI, this animal never existed before the 2017 Tax Cuts and Jobs Act. So before 2018, we never even knew what this was because it didn't exist. Trump would allow it to stay in play, where Biden says, again, using this $400,000 number, that if your income is higher than that, we're going to phase out your deduction. And today, when your income hits certain high points, there's phase outs, but there's loopholes around them depending on what the value of your assets are, what the amount of wages that you're paying is. But again, going back to this slide here, the Biden plan would phase out the QBI once your income exceeded 400 grand. So what do? Well, a few tax tips here I think you want to look at. Assuming that your taxable income and or tax rates are going to be higher in 21 than in 20, we want to see about pushing expenses back into 2021 or bringing income into 2020. And again, like the third bullet point shows here, accelerating qualified business income into 2020, where we don't have these same caps that may come into play. So one thing I'm going to be looking at is, let's say that we have a situation where right after the election, we know that the Democratic Party is going to control both houses of Congress, plus Biden is going to win. At that point, I'm going to be expecting that my QBI is going to be phased out in 2021. So therefore, I'm going to want to be accelerating income into 2020. And that would also be the case if I had a C corporation, meaning that I would want to have my income taxed at 21% this year, rather than having that same income taxed at 28% next year. So if I can move any income from January to December in a C corp, that's the way I would want to go. And likewise, by delaying business expenses, let's say in that same C corp, a business expense in 2020 is worth 21% of whatever the expense is, where in 2021 it would be worth 28%. Likewise, you could use the same with qualified business income. So let's say I may have an LLC, S corp partnership, something like that, where I may want to have more income, certainly again in 2020, where I don't have this issue with the qualified business income. Likewise, if I'm paying myself wages, maybe I can take a higher wage in 2020 to avoid any taxes on the excess of the 400K. So again, your wages may be 100,000 every year, or 20,000, excuse me, 20,000 every year, where it doesn't make any difference. But you may be in a situation where you've got 500,000 of compensation. Maybe we look at taking more this year and less next year if we can pull that off with our reasonable comp issues. So anyways, those are a few things that I think we want to look at. And I think we also want to look at depreciation and the Section 179 and bonus depreciation and what have you. And the reason I say this is that almost all of us think that if we go out and we buy a piece of equipment, so I was talking to somebody today that is going to be buying some medical equipment, and it's going to run $100,000. That person could deduct the full $100,000 this year, or they could decide to depreciate it over 5 years, or there's other options as well. But we were looking at it and thinking our income is going to be higher in 2021. We think that the tax rates are going to be higher as well in 2021. And we also have timing issues where we can then decide, actually, sometime in 21, when we're preparing our tax return, how do we want to claim this? So we're going to be able to buy equipment this year and also look at, do we want to depreciate that fully this year? Do we want to expense it in full using Section 179? Or do we want to defer it out where the benefits of the deduction could be higher because the tax rates themselves are higher as well? All right, I know that's a lot on the on the different stuff on the business part of it. A couple of other big changes I think that we're going to see. Again, no changes on disability provisions and tax credits under the current law, but the Biden plan would give tax credits of up to $5,000 for any employer who hires a person with disabilities. And then also, if you're making your business more accessible, there used to be ADA credits for the Americans with Disabilities Act and different tax credits to make your business more accessible, let's say wheelchair ramps or maybe expanding doorway widths, let's say for wheelchairs or something. We can get now a tax credit for this. Likewise, a big possible change here to the real estate investors. And this is one that we're really not hearing anything about, and I'm kind of surprised about that. For real estate investors, and for most of the investors that I've done tax planning for that have real estate involved, not looking at a 1031 exchange is just a crazy way to go about your tax planning for real estate. Anybody who is buying and selling real estate needs to be aware that there is this Section 1031 of the Internal Revenue Code that permits you to basically exchange your property, move into a different property, a different type of property even, commercial or residential or something, and not have to pay any taxes. And when you combine that with estate planning, it's possible that you could then go over and over and over again with like-kind exchanges until you finally pass away, and then with estate planning, see that there's no taxes being paid. Under the Biden plan, the like-kind exchanges would be eliminated for income over, and again, this 400,000. And my question here, and the reason I have income in quotes, is that I don't know what that income is. I don't know if that's adjusted gross income. I don't know if that's taxable income. I don't know if that's the income from the sale of a piece of real estate. But again, it's something that you have to be aware of, that this potential issue could go away next year. And it's something you may need to plan for one way or the other. All right, a couple final points here, and then we'll get to some of the Q&A and get you on with your rest of your evening here. Estate tax exclusion. And the couple of issues with the estate taxes, I think, are another area which is not really gathering any real information, or at least I'm not seeing it through the press. The like-kind exchanges, I guess I get that in the sense that it really doesn't apply to everybody, and if you're not doing real estate transactions, it's probably not going to apply to you. But the estate tax exclusion seems to fit the mold of death and taxes, right? That we're all going to pay taxes to some extent, and we're all going to die. So the estate tax exclusion currently at a little bit under $12 million per person. Excuse me there for flipping that one ahead. 11.58 million, and if you're married, you can effectively double that to get you up to that 23 million amount. So most people that would pass away this year or anything up to 2026, there's not going to be an estate tax bill, even if there had to be an estate tax return. Under the Biden plan, the reversion would be allowed to happen. And so we're not sure about the timing of that, if the reversion would be right away, or if in 2026, it would just go back to 5.5 million. And then the top rate would go from 40 to 55%. Again, I'm not sure about when the timing of the reversion is, but again, this is something that you will need to look at your overall estate plan, especially if not only the exemption changes, but the basis issue changes as well. And this is one of the biggest tax changes that I could see, certainly under estate planning, that I've seen in quite a while. And that is currently that when you receive estate inheritance property, okay, so from an estate, you receive an inheritance. And I'm going to use my IBM example where I buy IBM for 10,000 and I sell it for 40,000. I'm going to pay tax on that 30K. But what now if I don't sell it and I die and you inherit it? You then would inherit my IBM stock for $40,000, basically meaning that what was the value of IBM on the date of my death? In this case, it was 40,000. You could then turn around and sell it for 40,000 and pay no tax. Biden's plan would eliminate the step up in basis, which means that there would be major changes to the gift strategies and to the estate planning laws. And here's what I mean by that. If we're going to be in a situation where the estate tax goes down, so I'm going to go back to this slide 2 slides ago, and the estate tax goes down to 5.6 million on the exclusion, which is now about 11.6 million. Today, you could give away assets up to 11.6 million without owing any tax, assuming that you've never filed a gift tax before. You'd have to file gift tax returns, but you could do that today. Whereas if it reverts back to 5.6 million, those gifts on the remainder here, the extra 6 million or so, would now become taxable gifts. So my suggestion here with this tax tips is looking at the gifting strategies in 2020, and a lot of the commentators that I saw were talking about this use it or lose it strategy. And my first thought on estate planning is that's probably not a good strategy. I mean, use it or lose it is, what do you want? You want me to die this year and not have the Biden tax plan go into place? No, that's not what they were talking about. What they were referring to here was that if the law changes, they're not going to go back and do this clawback provision and pull it back. So what I'm referring to here is going back to this slide. The current exemption is 11.58 million. And let's say you had 10 million of assets and you were going to make gifts on that. You could make $10 million of gifts this year, file a gift tax return, and assuming you haven't used up the whole exemption in prior years, you would pay no tax. So now we have 10 million of gifts going out, and now at some point in the future, it reverts back to 5.5 million. What we would look at here is the clawback, and the IRS would not be able to go back and say that you've made gifts in excess of the 5.5 million, therefore we're going to want to tax you on that. So that's where the strategy is going to come in. We can gift in excess of 15K per person per year. Nothing has changed on that with the Biden plan or with the Trump proposal as well. So again, I think that's a few things that you want to be looking at, and I think you want to be looking at your estate plan and looking at any sort of discount valuations that you may be able to use now with gifting strategies, and being able to maybe reposition assets through estate planning, through maybe other business planning, where you look at the differences between a flow-through entity, let's say an LLC or an S Corp, and a C Corporation. And what would happen to your business if it's a C Corp and the rate goes from 21 to 28%? Or what would happen to your business, your situation, if you have an S Corporation and now you can't take full advantage of the different deductions for qualified business income? So, this stuff is really complicated. And again, we don't have to make any decisions right now as to, exactly what we want to do or don't want to do. But, my thought with this and my goal with putting this whole thing together for us tonight was just to start the thought process that if this happens in the election coming up, 30 days from now or whatever, that we can start to put these different plans in motion so that we don't get in a situation where the tax law changes sometime in 2021 and we did nothing in 2020, at least in the fourth quarter, when we had this opportunity. And I think that's what a lot of the tax planning is, knowing what your choices are. And that's what I use. I use a lot of the different webinars like Don was talking about here at the beginning. I use it just to help me in different areas where I don't know all the different choices. So I encourage you for sure. You can re-listen to this one. I've gone over and listened to one of the webinars on the CARES Act that Toby Mathis did. That I had been looking for that information from a lot of other sources, and guess what? It was right here, and that was by far the best webinar that I've seen on the different loans and Paycheck Protection Program and things like that to try to put it into English. So hopefully I've managed to do some of that tonight.